On this episode, I just was searching on the debt topic, and since I know from Rich Dad Poor Dad, Robert Kiyosaki, he told that debt debt a good debt can produce you income, and no different from the bad debt that put your money out from your pocket. And I just interesting about this topic, and I searched more content from it and found on the medium.com blog talk about most acceptable debt to income ratio for mortgage. And I just aware that we have the ratio from debt to income. And what is a debt to income ratio, DTI? Debt to income ratio is simply a measure of how much debt you are paying per month compared to how much money you make per month before taxes or other deductions gross income. How is debt to income ratio calculated? DTI is calculated by dividing your monthly debt payment by your monthly gross income multiplied by 100 to get a percentage. For example, money debt loan $2,560 and monthly income gross $8,000. You will have the ratio of it around 32%. DTI equal 32%. What is the most acceptable debt to income ratio? The most acceptable debt to income ratio that most lender prefer is 36% or lower. 36% or lower. The lower the ratio that the lower the ratio, the better. A low DTI simply indicates that most of your income is not being used for servicing debt, and that you can manage a mortgage. This helps boost the confidence of lenders in you and actually makes lend you money. A high DTI that most lenders can still consider is 43%. High DTIs, however, are not a good sign and might scare lender away because a huge chunk of your income is basically paying debt. They are simply not sure that you will be able to pay them back in case anything happens to your main source of income. There is a slim chance, depending on the lender, that are filters. They might go in 49% depending on other factor. Nonetheless, maintaining a lower percentage is the best way to secure a mortgage. What is front-end debt to income ratio? Simply put, a front-end DTI is a measure of what percentage of your debt is servicing housing costs such as mortgage, insurance, or payment. Instead of dividing total monthly debt by monthly debt load by gross monthly income, front end is calculated by dividing housing expense by gross monthly income multiplied by 100 to get a percentage. Front end DTI is housing expense from amount, mortgage, rent, and so on, divided by gross monthly income. Most lenders consider 28% or lower to be good front-end DTI. However, depending on the lender, that figure might vary since they all analyze different other factors related to your DTI. Why is debt to income ratio important? Number one, helps lender determine if they will lend you money. Number two, if your percentage are looking good, you will be approved quicker. Number three, it can help your loan modification process and therefore avoid closure. And number four, keep help you keep track on your personal finance. And how can you lower DTI ratio? Number one, try paying more than your minimum limit. Number two, consider your housing expense such as rent. Number three, pay high interest loans first. Pay high interest loan first. And number four, get a promotion, increase your income. Number five, consult professional financial advisor. The conclusion of this is debt to income ratio is pivotal in helping you secure mortgage, just like credit score is important to lenders. So is DTI a good ratio can afford you quick processing and loan modification during hard time. You can also use DTI ratio as a simple tool to track the health of your finance. And another topic about debt from richdad.com talking about it. He suggests get out of debt. Scam number 7, get out of debt. Lots of people will tell you how to get out of debt, but you need to know how to use debt instead. Okay, this is the you should get out of debt because it's bad. And the number one reason why you so-called experts will tell you to get out of debt is because they believe that is bad for you. Remember the rich dad scams. We identify are the way the rich stay rich and make sure the poor stay poor. That can be counterintuitive, especially when some of the scam like getting out of debt and saving money seems like they would help you get rich, but it's the scam. The rich carry debt. They generally carry a lot of debt, but they have assets that more than make up for the debt they carry. In fact, the rich not only carry debt, they also use it to get richer. The rich know that if everyone understood debt and how to use it to get rich, they would have more competition for the assets they buy with that debt to get rich. The rich and so-called financial experts also think they are the smartest people in the room, that they think that for the most people that is bad because most people are too stupid to use that the right way to get rich. By but they speak out of both sides of their mouth. They talk about how debt is bad and how you should get out of debt. But they also make their money of selling the poor things that they take loans out or use credit cards to pay for things like cars, vacations, clothes, TVs, houses, and more. Get out of debt. Ultimately, the difference between the rich and poor when it comes to debt is understanding the difference between good debt and bad debt. The rich dad company exists to help level playing field. That's why we export rich dad scams like get out of debt. Instead, we want to teach you between different between good debt and bad debt. Get out of the bad debt and get into good debt. Bad debt is debt that makes you poorer, such as credit card debt, car loans, and more. This is the type of debt used to buy liabilities. Ironically, this is a debt that those who say that is bad get rich from selling to the poor. Good debt is that make you richer, such as loan for investment property or to purchase equipment for your business that will make you a return. Uh, make you a return. This is the type of debt that is used to buy assets. The rich use this kind of debt to buy assets and or create products that they sell to the poor. The often who often take out bad debt to buy them. Perhaps you are seeing how it works. An easy example of good debt is my real estate holding. By getting a loan from the bank, I can purchase a property with only small percentage of out of my pocket, at the most 20%, but sometimes much less. I then rent the property and my talent pays the cost of the debt while putting my money putting money in my pocket. For example, in the real estate, I can buy investing property with debt. The bank will give me loan for 80% of purchase price, while I only have to use my money or someone else for 20% of the purchase price. My job is to find a deal that pays the bank the interest on 80% while still providing a decent return on 20%. So using simple math, if you have $100,000 in cash, you could buy a property for 100,000 that give off 800 a month in full cash, a little over 9% annual return. Or you could, or I could use a good debt to buy 500,000 properties. The bank would lend me 80,000 dollars for each property, and I would divide my 100,000 into five to $20,000 down payments at 5% interest. The payment and the loans would be around $500. So my cash flow on each property would be 300 a month, 800 in rent, 5 in the debt payment, 3 totally 300 per month for a total of 1,500 per month and 18 annual return. This is twice as much as if I only use my own money to invest. How could that make you richer? I have Robert Kiyosaki have a excellent example of how the good debt concept works. Say I have $100,000, maybe I inherited it or sold something valuable, but I have this money. I could put it into a mutual fund, which is a little better than saving it. The return on it would be a bit more than just putting it in a saving, but it won't be a lot. However, if I use that $100,000 as a down payment on a 500,000 property, then I have actually bought 500,000 in value with just 100,000. The difference that 400,000 is good debt. Like my example above, if I play my cards right, the property can cash flow. So not only I have expanded my wealth, but putting a 500,000 asset in my assets column with just 100,000. But if I can also realize positive cash flow each month and my tenants pay down my debt for me. For this is exactly what my wife Kim did on a smaller scale with her first investment. She bought 45 thousand house with 5,000 down payment, uh, acquiring for 40,000 in good debt, and she puts that property to work. The tenants paid the mortgage and the taxes on it for her. She was profiting or generating a positive cash flow of $25 a month. It wasn't a lot, but it was a start. She used same practical practice over and over again, and she kept putting that money to work. Today, she invests in monies in millions, but the concept is the same. Today, rather than buy into the lie of rich dad scams, number seven, get out of debt. I encourage you to instead increase your education on begin learning how you can make good debt for you. Thank you for today.